Hello and welcome to this week's episode for SPY Trader Now. I am your host. My name is Ken, and our model portfolio is up 33.57% year to date. We have a green for the stock market strength color signal, and our number one goal here at SPY Trader Now is to beat the returns of the S&P 500 buy and hold investor. We are accomplishing that goal. The S&P 500 buy and hold investors portfolio was up 26.9% year to date. We are up 33.57. So we are beating them by more than 5%, way more than 5%. And believe it or not, we are in the triple digits. Fantastic returns so far this year. This is going to be a month-end video, so it's going to be a longer content video compared to the intra-month videos that I do. So we're going to give you packed full of data, wrapping up the entire month, and then showing you what we plan on doing for next month's trades. Let's get into this right now. Okay, for today's video content, we are going to go over what this video is all about. This video is for retail investors. We do a deep dive on the technical analysis of the S&P 500. We not only do the technical analysis, but we show you exactly how we are trading our model portfolio to get these returns. I am not sure if another YouTuber does this, but if you are aware of another YouTuber is as transparent as I am on the model portfolio, please drop their link in the description, in the comment section down below, so that I can review that person's channel. Thank you very much. I appreciate that. I'm going to show you how well our model portfolio is doing against the benchmark of the S&P 500. So it's very important for us to have a comparison basis to know how well we are doing overall. We're going to look at the federal funds rate and the current Fed policy, U.S. presidential election theory, interest rate yield curve, CNN Business Fear and Greed Index, seasonality, ratio charts, the VIX or Volatility Fear Index, and then at the end of the video, we're going to show you the market summation with the closing thoughts on our next trades. Let's get into this right now. Here are some past returns for the model portfolio. All right. Last week, the S&P 500, by the way, we use the ETF SPY, we refer to that as spiders. It's the S&P 500 ETF. Spiders, very common, very well known throughout the industry, and extremely traded product, okay? Now, last week, the S&P 500 gained 1.29%. Now, this here is a weekly chart with a duration of 5 years. It's a candlestick chart. Now, in this chart, what I am observing here is I am observing that we have a rising wedge going on. So this here would be resistance, and this pink line here would be support. And I put in this blue line here to represent a possible breakdown location that we could hit if this market were to start to falter. I got this distance from here to here based off of the distance from the top of the trend line to the bottom of the trend line here at the greatest point. So that is a potential for us to drop down to 530. Do I think that's going to happen in the next 2 weeks? No, I do not. But I want to keep this in the back of my mind that this potential is out there, especially if this trend line is broken. So I'm going to be keeping an eye on this trend line, and I want to keep an eye on that. We did have a negative divergence from the MACD, which is here at the bottom oscillator. This line right here has now just broken out above it with last week's trading action. So this negative divergence is now alleviated for the MACD as long as we stay above this trend line or resistance line that was drawn in. So far so good. The slow stochastics is looking positive. So right now you're looking at bullish action. Looking here on the thumbnail, you'll see that on Friday's trading, we broke out again to new all-time highs. Usually all-time highs begets all-time highs. So unless something were to happen, it looks like we're going to continue moving sideways to up according to this track and according to this chart, unless we start breaking down and that pink line starts showing that it's been compromised. So we absolutely want to keep an eye on this and make sure that when, I shouldn't say if, but eventually when this pink support line is broken, we want to be cognizant of the fact of how much it could fall. And we don't want to be caught without having some type of protection in our portfolio during that time frame. So we just want to be aware that that is a possibility on this weekly chart. Let's move forward. Last week, we did make one trade. So this trade went out on Monday, November 25th, 8:23 a.m. Pacific Standard Time. We want to sell to open 2 covered calls and leave all other trades in place. So we did do 2 covered calls. We did a strike price of 600, expiration 11:29, which was Friday's trade. We received about $1.95 for that trade, or $390. Here are some of the trades that we've made in 2024. If you want to see all of my trades going back for the last 3 years, you can head over to this website. There will be a link for it in the description down below. Now, the yellow represents our current open trade. So we currently only have one call that we have. We have one long call, one long contract for a call. We purchased that for $1,939. We are positive because the market has been going up. We're profitable by $249 or 12.84% in that position. Now, we were holding 200 shares of SPY, but that got closed out on 11/30/24, and we did make a nice healthy profit of $5,710 or 5%. But because I had a covered call, which is this transaction right here, with the strike price of 600, and on the expiration date, which was 11/29/24, the market closed above that, our shares got taken away from us. So on that transaction, which was that covered call, we did make $388. So we're doing fine there. Shares got taken away. We made some money on the 200 shares that we had because we had purchased that for $571.45 per share. All good. There's no problem right now. We know that we are cash rich in our portfolio. So when you look at our portfolio, going back here to the beginning of this presentation, you'll see that we currently have $2,000 in options. That's at one long call, but look at our cash position, $131,000. So we are holding a massive cash position at this time. So just keep that in mind. So when we go to deploy in the following weeks, we know that we've got plenty of cash to do whatever we want with. If you want to see how I trade this model portfolio, I want you to smash that like button down for me, subscribe to my channel, and ring that bell to be notified when I post a new video. Now we are looking at a comparison chart between our model portfolio in blue and the S&P 500 buy and hold investor in pink. You can clearly see that we are beating them. You can see the exact returns right here. What's important as well is you can see how slow and steady upward our trajectory has been on the model portfolio. Not that many gyrations, definitely an equity curve that you would like to see in any portfolio. Now we are looking at the Fed chair, Jerome Powell. We want to see what he did. Well, and the announcement made November 7th, the Fed cut 25 basis points. This was on the heels of him cutting 50 basis points on September 18th. The next announcement is December 18th. So what do we got? A couple of weeks for that. What is the expectation? A rate hold, cut, or hike? I've got cut highlighted. And the reason why I have cut highlighted is because of what Jerome Powell said with his own words. The Federal Reserve slashed interest rates by 0.5 percentage points on Wednesday. That was on this one, September 18th. And charted a course for 2 additional cuts this year, followed by 4 more in 2025. Now that's what the Fed Chair Jerome Powell said around September 18th. The data that has come out since then has shown that inflation is still kind of sticky, which the economy is still pretty strong. And for him to show that he wants to cut rates, the data isn't really supporting that. On the December 18th, instead of him doing a cut, he may do a hold and not do anything and push this out because the economy is pretty strong at this time. Now we are looking at chart TNX. This is 10-year U.S. Treasury yields. Now that is the candlestick chart. In dark blue, which is right there and right here, that's the S&P 500. In black, we have TLT, 20-year bonds. That's the black right there. Now, when you look at the candlesticks, you'll notice that, boom, we went straight up. We held there for a while. We have finally started to break down. As a side note, in my personal 401k account, I did end up buying some bonds because that's one of the mutual funds offered in my 401k. And I just put that up there and I bought it somewhere around here. And I bought it with a little bit more going a little bit higher. And now that the 10-year U.S. Treasury yields have come down, the one that I bought mimics chart number TLT, and you can see TLT is beginning to take off like a rocket ship. So if you are long TLT right now, you're doing pretty good because the bottom for TLT was in place right there and it's gone straight up. So that's excellent for people that have held bond funds in the short term. Now, you'll also notice that on this 10-year chart, look at the MACD. MACD is below its signal line heading south. Now, slow stochastics has already headed south, but you can see that it looks like it's bottomed here below the 20 line. So it could do a pop-up and then come back down. You know, it's hard to say exactly how this is going to play out, but we do know that overall it shot up like a rocket ship and it should give back at least 50% of that. So it's got some more to go, if not even more than 75% of it. So I'm thinking that we still have more to go for the 10-year bond yields or treasury yields to fall down. But that is what is happening with TNX. Now we are going to look at the U.S. presidential election cycle theory, okay? Now, President Biden is currently in the 4th year of his term. Historically, for the S&P 500, those rates of returns are 6.7%, and for the NASDAQ 100, that would be 9.43%. Where are we currently at? The buy and hold investor for the S&P 500 is at 26%. Historically, the 4th year of the presidential cycle only averages 6.7%. This has been an outstanding year for the buy and hold investor, 26.9%. So keep that in mind when you compare yourselves against historical averages. We are way high. This market could correct 20% and still be within the historical normal average range. So there is risk at this level that I want to present and I want you to recognize. Now we're going to look at things from a bond market outlook. Now, I get my data from bankrate.com, and I'm sorry to say that bankrate.com has not updated my information on yields since 11/6/24. And that is, for some reason, they're dropping the ball. I sent them an email saying, hey, how come you're not updating this? So this chart is a little seasoned. But what do we see here? What we have happening here is we had an inverted yield curve, and now the yield curve is changing around. So if you look at the short-term 91-day, which is a 3-month yield curve, 4.44, and you compare that against the 2-year and the 10-year, well, it is smack dab just about equal with the 10-year, and it is still higher than the 2-year, but you can see that the 2-year is finally below the 10-year, meaning that you are now inverting, your yield curve is normalizing, because we had an inverted yield curve. We're getting to a normalized yield curve. Now, normally speaking, after the yield curve normalizes, especially from the 2 to 10 ratio, 1 to 4 months after the inversion begins is when the economy usually starts showing lackluster results, including the stock market. So we want to recognize that now that the yield curve has gone from inverted over towards a normalizing yield curve, we still are waiting for the 3-month yield to change and get below the 2 and 10, which it's not right now, but I expect it to happen within the next few months. Well, when that happens, then we do expect a U.S. recession, and we do expect some type of a stock market decline. And so we want to not be caught without knowing that information and making sure that we don't have too many long positions in our model portfolio. Now we are going to look at the CNN Business Fear and Greed Index. Here is our friend Warren Buffett, the Oracle of Omaha. We stand at greed. Last week, we were at 60 and in greed, and this week we are at 66. So we do want to recognize that greed is increasing. Why? Because the stock market is starting to make all-time new highs. When the stock market does that, of course the greed is going to increase. Now we are going to look at seasonality. This is a monthly chart for the S&P 500, and for the month of November, the S&P 500 has gained 6.02%. Incredible candle that it had there for the month of November. Now, on a seasonality basis, going back 5 years, for the month of November, there was an 80% probability we're going to close higher. We absolutely did that by 6.02%. But guess what? The month of November is now gone. Now we are going to enter a new month. We are in the month of December. So let's look and focus on December. December has a 75% probability going back 5 years that we're going to close the month higher than when we opened it. 75% going back 5 years. Keep that in mind. Also, I want to point out, going back to long-term returns for the S&P 500, you have returns averaging 10 to 7.52%. Currently, the S&P 500 is up 26.9%. Is there risk in this market? You bet there is risk in this market compared to the historical averages. Now, staying on seasonality, going back 10 years for the S&P 500, month of December, 67%. Going back 20 years, month of December, 68%. So December is a good month, not quite as good as the month of November. November, we gained 6%. Look, did you see those seasonality? I mean, those 30-year, 10 and 30-year averages where we gained basically between 7 and 10.4%? We were up 6% last month. It would not be unreasonable for us to correct at least 3% this month. Keep that in mind, and we want to be aware of a potential 3% correction, giving back at least half of that 6% that was gained just last month. Now we are looking at a monthly chart for the spiders. This duration is going back 20 years. All right. Now in this chart, we do show you a couple of corrections. 19% correction here in 2020, 25% correction here in 2022. Now, I did draw in a line here, a resistance line. And what else do we have here going on? You know, this particular, if I was to take and do a parallel line from here and grab it from here and do it parallel, it would be about there, right? So this could continue on a little bit more until it tags that. So there's a little bit more that could be squeezed out of this market. But boy, it does feel stretched. Now I'm going to go and deep dive on the next slide, but you can see how stretched the MACD is. The last time the MACD was this stretched and it started to correct, we had a 25% correction in the market. We do not want to be caught long on a 25% correction in the market. So we want to be aware of that. Now, we are now looking at that same chart, going back a good level, but I actually did a little bit more research. I went all the way back to 1993. SPY has only had 2 MACD levels above 40, and the last one had a 25% correction. So I did long-term studies on this. This is the highest that the MACD has been going back all the way to 1993. And the last time that we experienced this, it was 25% correction, as I stated. So we want to recognize that we have absolute risk in this market, and we want to be careful of that. Now we are looking at a weekly chart for the spiders, duration of 5 years. These candlesticks represent 1 week's worth of action, a couple of pullbacks here of 9% and 9.6%. Now, what is this blue line right here? So this blue line represents how much that we could, if this trend line here is broken, could fall down to. But we are making all-time new highs. So, and over here, you can see that our negative divergence has cleared out and we are looking positive. So this market can absolutely continue and grind forward. Now we're looking at a daily 6-month duration candlestick chart for the S&P 500. Now, I want to show you this. This trend line here taken from that low to this low, and that's this right here. Then the S&P 500 started to accelerate its advancement, and it went to the low, to the high, to a higher low, and now to this high right here, slightly higher than the old high right there. But the level of advancement has a steeper angle to it. So I put in a stronger trend line. When you start to see this type of an action where you have a trend line and then you start doing steeper trend lines, well, eventually that is going to fall down to and come down back to earth. And so when that happens, that's when you could experience a correction. Now, this line here that I drew from this upper trend line here to this bottom support line here is this exact line right here. So if this trend line here were to be broken, we could fall down to the 575 level. So we just want to be aware that that is a possibility. Now we are looking at a ratio chart of the NASDAQ 100 compared to the S&P 500. We also have the S&P 500 in blue and the NASDAQ 100 in black. That's these lines here, blue right there and black right there. They're very close to one another, and they are both traveling north as of late. But what is the ratio chart doing? The ratio chart was in this trading channel here. It broke down and it is below our moving averages. We have the 50-day in green and the 10-day in red. We are traveling below both of those. It does look like we've put in a bottom, and it is possible that this is now going to take off, being bullish for the market. Now, we do have on the MACD these lines that we were in. We did fall down out of those lines, but it looks like, and you can see it on the histogram here, with the trajectory is starting to travel north. Slow stochastics, let's see here, are about equal, and it looks like we've lost a little bit of our trajectory here. You can see where that angle of ascent has changed. And so it looks like this could be a bottom on this chart, and it could be traveling north. That will be bullish for both the NASDAQ 100 and the S&P 500. We have another ratio chart for the equally weighted S&P 500 to the normal cap weighted S&P 500. That chart is the one that is in red and black, okay? We also have the S&P 500 in blue and the equally weighted 500 in lime green. Now you can see that the blue and lime green have been traveling north. The ratio chart starting here has been traveling south. But as of late, it's been traveling sideways. Now, when this ratio chart does that line or that line right there, hold on, let me clean this up so you can see this 100% so you see what I'm talking about. What I'm talking about is that line right there and that line right there. That line has not happened yet. What is that line? Well, the S&P, the ratio chart, after it has gone south and in the toilet, and it traveled sideways for some time, then eventually it got out of the toilet and bam, it started heading north, traveling sideways, and then bam, it started heading north. What happened to the S&P 500 during this time frame? After you crossed and went north on the ratio chart, look at your dark blue line, the S&P 500. Bam, long bull run. Right here, if you just take that and just go straight up with it, look at that. Bam, positive run. That line has yet to reveal itself yet on this ratio chart. But when it does, we are going to be taking on good longs with leverage. What I mean by that is options when that happens, because the market appears that it has reached its bottom and it's going to travel north. The only problem that exists here is that in this chart, it goes back 20 years, okay? And it's a weekly chart. Now, the only problem that happens that I see here is that the last two times that we went into the toilet on the ratio chart, the S&P 500 experienced a 40% correction the first time and a 20% correction the second time. This time around, when it went from here into the toilet, you'll see there was nothing. There was a small pullback right there. So small, I don't even want to mention it. So we won't even consider it. This chart has done nothing but travel north. Where's our 19 to 40% correction? Bam, coming down on the S&P 500. That has not happened yet. Now, I did talk about the inverted yield curve. I did talk about how now we're looking at a normalized yield curve. 1 to 4 months after that, we start to see recessionary action in the economy and softening in the S&P 500. Well, we have not seen that yet in the S&P 500, but considering that this ratio chart in the last 20 years has saw it twice, in both times that it happened, good solid corrections, we're in the toilet on the ratio chart right now. Where's our correction? That could be in 2024. So I'm going to be very, let's just say, ready to take funds and put them on the sidelines or put some puts on if I start seeing this market traveling south in 2024. So I'm going to be very ready to do that. But it has not happened yet. Now, I want to show you something here. I got highlighted. Look at the MACD. The MACD on this ratio chart started to travel towards its signal line, never breached it, and bounced and started traveling north. The distance between the signal line and the MACD is gaining distance. That's bullish. That is very bullish for this ratio chart, telling me that it is possible that this ratio chart could start traveling north without the S&P 500 correction. Now, if that were to happen, that would be unbelievable, because in the last 20 years, it absolutely did happen. But if it doesn't happen this time, I have to go with the flow. I have to go with what the data is telling me. And the data at that point in time is telling me to be long this market. So I want to be on the lookout for that. We're going to keep this chart up on the monthly. We don't do this chart on the intra-month. We do it on the month-end videos. This is a month-end video. That's why it's a longer duration. We want to see that come up. If that comes up, we're going to be going bullish this market. We're going to be going long with leverage this market. Now we are looking at the VIX volatility or fear index. That is the candlestick section of this chart. 3 ranges. Above this range, upper range, bearish. Below this green line, low range, and it is bullish. Below this green line is the ultra low range, and that is bullish as well. Where are we at? We're in the ultra low range. This market has no fear. If there is no fear in this market is going to be traveling north. So we want to be long the S&P 500 because right now the market is not showing fear. Now I do have some cycle brackets down here at the bottom. I do see that we are getting close to a cycle low right there. When that happens and we start getting this upward energy right there, that could be a bounce like this on the VIX. And when this is inverse to the S&P 500, which is here in blue, once the VIX starts traveling north, the S&P 500 will travel south. I would not be surprised to see a 3% pullback in the S&P 500 before it starts traveling north again. So right now I'm actually in cash because I got taken out on Friday because of those covered calls. Those covered calls got exercised because they were in the money at that point in time, and so they got taken away. So right now I've got my shares in cash. If there's a market pullback next week, guess what? I'm just going to wait for the pullback and then go in and buy long. All right, we are looking at a 3-year weekly chart for the S&P 500 in the Think or Swim platform. Now, in this chart, we also have standard deviations, +2 and -2 in gold, +1, -1 in pink, regression line in dashed green. What is happening here? Well, we are clearly at the +1 standard deviation right there. Now, we know that when you reach the +1 or -1 standard deviation, there is a 68% probability that you are going to stay within one standard deviation. Once you get up to the +2 and -2, there is a 96% probability you will stay within those standard deviations. So now that we're starting to breach the +1, you start to increase the probabilities that you're going to be softening and coming down. Now I want to point out that I've got a couple of alerts built into the platform to send to my cell phone. This one here is sent at 586 if we were to drop down to that level. The other one is at 610. I am thinking that we are going to possibly come up, tag the 610 before we travel sideways, and then come down a little bit. Get closer to the 586, and who knows? Could go down even further before this market starts turning around, and then eventually come back up and break the old highs. So just want to keep those alerts out there. So I'm not going to be very just ready to pull the trigger on money to go buy shares. I want to be a little bit passive in that because I don't think there's much left to squeeze out before we have a little bit of a pullback. There's a little bit more sideways action that I see happening here in the S&P 500. So getting some type of a time premium on options, that would be one way to play this. And we'll go through that at the end of this video. Let's change over now and let's go to the daily 1-year chart. Let's change our cycle brackets to 1-year daily. Now, looking at this, I can see that we've had a positive cycle here, positive cycle here. What I mean by that, and just in case you're not aware, is that I see a low there and I see a low there. This low, and then I see a higher low. And we had a peak in between, a higher low, and then we went into the next cycle. This next cycle was also positive, meaning that this high surpassed this high over here. So that was good as well. So positive cycle when the low of the end of the cycle is higher than the beginning low. And when you have the peak surpassing the last cycle's peak, that is also positive. This cycle here was neutral. Even though this one did surpass the old peak here, it didn't surpass it on the lows. It was equal before it found a footing and then started traveling north. So right now, you have a low and you have a higher low. If that higher low stays in place, this cycle right here is going to be a positive cycle. And we are now in the upward trajectory phase of this cycle. Well, it's not going to take much for it to surpass this high before we start traveling sideways, come back down to some low. That low theoretically should be higher than this low or equal to this low if it's a neutral. And at that point in time, between these two lines, that's when you want to buy for the next cycle going long. Now we are looking at a spreadsheet that I created in an effort to determine the health of various asset classes as well as the 11 S&P 500 sectors. And the highest number you can get is a 6. So anything with a 5 or a 6 gets the color green. If it is less than a 5 or a 6, it gets no color at all. The more green on the screen, the healthier or stronger the market is. Now, when it comes to various asset classes, I want to compare last week's reading 59 to the current week's reading 59. We are in yellow. Things are looking not great here on various asset classes. When it comes to the 11 sectors of the S&P 500, look at the amount of green on the screen. Last week we were at 80, this week we're at 86, and we have a green. There is strength in the S&P 500. That is going to take us to the ending of this video. As of November 30th, 2024, the market summation, according to me, Ken, your friendly host for Spy Trader Now. The market is bullish. We know the market is bullish. It just made an all-time new high. We had a covered call that got exercised on Friday at $600 a share. I showed you that. I showed you all the trading earlier in this video. We currently hold one long call and the rest is in cash, as I explained to you earlier in the video. We do want to get back into this market holding SPY. I see us still in a rising phase till about 610 or 611. I will buy 200 shares of SPY at the market on Monday or Tuesday, looking for a 1 to 3% decline, then hold till 610 is hit, and then sell in the money covered calls at 585 going out 1 week. So what I'm trying to say here is that what I would like to have happen is I would like to see a little bit of a pullback next week between 1 and 3%. Now, I know I said Monday or Tuesday, take that with a grain of salt. Depending upon what I see on the trading action will really determine how and when I place my next trades. I may or may not want to put them on Monday or Tuesday, or I may just, instead of buying 200 shares, buy 100 shares, take a 50% position, pyramid into the position. So it is possible that I do want to do that. You can see here from the chart that we have on this slide of exactly what the market is doing. We are in a rising phase here, but how much is it going to rise before it begins to falter and then come down? So anytime you have the money in the market, keep in mind that your money is at risk. So I want to put the odds of probabilities in my favor. And do I want to do that right here at this juncture? Maybe. Not with the full position, maybe with the half position, and see if this market continues to take off. Something like that. I want to be a little bit cautious of exactly how much amount of capital I have at risk at this juncture. Even though I make these comments and I make these predictions about what the market is doing, the market is an 800-pound gorilla. And this 800-pound gorilla will do whatever it wants to do, whenever it wants to do it. If you want to learn more about me, you can go ahead and head over to this web link right here. It will be in the description down below if you would like to become a subscriber and receive my real-time trade alerts. I hope you got some valuable information out of this video. If you have not done so already, I want you to hit that like button, subscribe to my channel, and ring that bell. Thank you and wish you good trading.